right, hello and welcome to the CoStar News Hotels podcast. I am news editor Sean McCracken here, as always, for our Asia Pacific podcast with Jesper Palmqvist of STR, and we are joined with a special guest this month, the first time we've had a special guest during the APAC pod, Steve Carroll, who's head of hotels for the Asia Pacific at CBRE. Steve and Jesper, how are you guys doing today?
Hey, Sean.
Good.
Hey.
Yeah, thanks for joining, Steve. This course is we've got some great company. We're clearly running out of things to say, Sean and I. So thanks for joining.
Well, luckily, I don't actually have to say that much. All right, so we will start off giving the audience kind of the overview around Asia Pacific, which I know is a big region. There's a lot of things going on. So, Jesper, what are the highlights?
Well, I was with Steve last week when we were in Japan for another one of these conferences and events that have around the world. And a couple of things that I'm focused on, and I think towards the end of the year in this Q4 to see which markets will end up where we forecasted them to be in terms of correcting and reaching that level. And one of the focus areas would be both in terms of luxury and how everything is tightening overall. But luxury has been interesting to see how, so I was studying more the gap between luxury segment in hotels and all the other classes. And you're seeing divergence in some of the markets where there's a difference between how luxury is moving different, but also if you do year to date versus 12 months. And I think Thailand, as being a market where obviously had 6 months of softer growth, but the total market, I suppose the upside for the last 45 days has been that Thailand has maybe turned a corner, because this was the first month in October since the start of the year where we see positive growth year over year. So that's obviously a big change, both total markets, but about 3 percentage points in RevPAR, and luxury even more, like 5-6%. So as you come into shoulder season and into peak, I suppose there was a hope and expectancy of that, but coming out of the gates reasonably strong. So that's a good sign for key markets in Thailand. And otherwise in Southeast Asia, Indonesia is also closing that gap in occupancy towards the end of the year. Because, throughout the year, there was the government constraints and what's happening, and ADR already driving. But now you have some positive months. October overall was a good month. Also in Singapore, you now finally have flat overall, and year to date, moving towards what we forecasted, that Singapore will end up in a decent place after some rate challenges on early weekdays. Otherwise, Australia's growth, it's luxury just a little bit more. And since we're in Japan, everything's driving, right? The supply and demand balance is very favorable, but there's a lot of focus on luxury because there is that gap in terms of luxury hotels in the market across the big three, but just there could be a lot more luxury hotels and a lot of conversion around that.
Steve, what are you seeing in terms of the broad trends?
Oh, no. On the back of that, I guess that sound operational performance, and generally speaking across sort of all markets, I think demand is continuing to rise. I guess we still have a lack of mainland Chinese traveling outbound, not just to APAC, but globally when you compare it to sort of 2019. So that's still in somewhat recovery mode, but progressing, in particular in some of the Asian markets. So demand is sound. On the back of sort of COVID, more expensive construction, I guess difficult financing over a number of years, development pipeline has really slowed. And when you sort of look forward, the supply of new stock is sort of half of what it was as a CAGR over the last sort of decade. And generally speaking, that's in sort of most markets. So on the back of that supply-demand imbalance, with demand being higher, you're going to continue to see, in our eyes, above ADR growth and above sort of historical levels and above inflationary sort of growth, which bodes well for hotels in an investment sense. It means you're above inflation, you're above the other asset classes that are linked to inflation. So not surprisingly, we, in a capital markets sense, are having a really strong year on the investment sort of side. That coincides with sort of the debt cost coming off nearly in all markets, obviously, except for Japan, where debt is remained relatively cheap for the best part of two decades. There is some movement there and potentially some increase in debt in Japan, but it's certainly not slowing activity. The key investment markets. We were in Japan last week. Is our number one market is Japan. Both onshore investors and offshore investors are continue to pouring into Japan. Luxury is leading the way, but Japan's driven by that sort of mid-tier hotel where it makes up a high percentage of the total sort of room stock. So Japan by far is the leader, but other markets like Seoul and Hong Kong are rising to the surface, and the stability of Singapore is always of interest, and Australia continues to be that transparent sort of market that people really feel comfortable in investing in. So overall, good market year on year from an investment activity, and we expect the full year to get close to 2024, but slightly off. But year to date, we're sort of line balling at sort of circa 12.5, 13 billion of trades over APAC.
Steve, I was thinking about that operational efficiency that I was talking so much about last week in Japan. Do you think I'm exaggerating that, or it just feels like it's so, and Korea as well, when you get a portfolio and can just flip it, and the SC Capital everyone's talking about, you get a portfolio and the yield that you can improve so incredibly quickly compared to others. I mean, if that's the case, do you think that'll continue for much longer?
There still is, look, from a value add play, the largest, in particular, offshore capital into both. If you use Korea and Japan, a lot of the offshore capital is either value add or opportunistic, driven by the private equity firms globally that are similar names to around the world. To do that, you need markets to be positive, i.e., you get market growth, but on top of that, you need asset level like initiatives and asset management. One of the biggest things in Japan and Korea is it's a very underpenetrated brand environment, i.e. international brands, a very small percentage compared to sort of our counterparts in North America and Europe, as an example. In some cases, it's under 10% of total stock. So bringing in international brand and driving efficiencies and processes and distribution and loyalty via the brands by replacing independent and or domestic brands without the sort of scale. Definitely, there's lots of case studies that prove that up. You still have to execute it. So there's not all the winners, but when executed correctly, in particular when you have markets like Japan and Korea that are being driven by inbound. And so I think that definitely is going to continue. And as I said before, the brands are underpenetrated. The ADR growth is there, but the ADR growth in both markets is driven by international customers, not domestic customers. So that sort of case study holds. But as I said, you still have to execute that strategy successfully, and lots of parties have.
It seems like that can't last forever, though, right? You'd assume in Japan in particular is everything that, the international Western brands would want, and especially since so much of the demand is inbound to Japan. Like, it seems like it's such a obvious, like, that's where they need to be growing. Like, doesn't it have to grow at some point?
I think what you'll find is what we're seeing in these huge growth rates is it is driven by inbound. If you actually pick up the domestic demand, the rate growth is far less than what you're sort of seeing in the broader sort of sense. And you're getting now to points like Tokyo, Kyoto, Osaka, where over half of the demand into the hotels is driven by inbound, which is driving the rate. In markets with much a smaller percentage of that inbound market, ADR growth is lower. When you start to look at some of the Japanese hoteliers and their brands, they probably just haven't got the scale and the systems and the revenue management systems to revenue manage as proactively and as scientifically via the algorithms. Some of it is still manual, some of it's still plugging away with static rates rather than demand-based pricing. So I guess, yes, it seems like it's too easy to believe, but those inefficiencies still exist today, and I think will play out in the next 1 to 2 cycles.
Yeah, and I think you can see that as well when you look to your point, the regional markets, right? Who for the last years, we were talking about how the pricing out against domestic travelers, business travelers, but set aside a market like Fukuoka that's seen a lot of stuff, but even the other second tier markets in Japan, it is a very different picture and how it's growing, where most of the domestic are traveling, but for sure. But I also like to see when you mentioned earlier on China, how I try to take these number of markets and see when are they turning, like to see some kind of indicator. And what I liked this month about Beijing was that they are flat and we have in RevPAR growth, and we haven't seen that in a while, right? 18 months or something. So some of the sectors there are starting to, I mean, it's too early to say that SOEs are coming back and doing events and things that is such a big driver. But if Beijing starts to at least perform, and obviously year over year is a bit tricky because now we're getting into the bad months that has been for a while. So you'll organically see some growth. But if they can start turning around in the winter time when business slows down a bit, then I suppose there is a little bit of hope that, because domestic China needs to start first before more of the outbound comes.
Yeah. Agree. Totally agree.
There's a lot of headlines in the last month, though, about where Chinese travelers are heading. And it seems like no on Japan, a little bit more in India, and a lot more in South Korea, which make what you will out of that.
Well, I mean, the first point was, which they obviously like to talk about here in Singapore with STB, it's the more mature tourism boards are talking tourism receipts more than the actual numbers. We've seen a shift in the type of traveler. So even if the volume isn't there, the spend per Chinese passenger or traveler is higher. And that's obviously often a good thing. It means that if you are a hotel or a destination that are dependent on the past type of traveler, you will suffer. So we talked about that before, and I think we're seeing that more apart from these movements. China is one of the few countries that controls its travel very rapidly and very quickly, and Korea has seen a surge, as had Japan obviously for quite a while now, and many other markets too. So it's starting to see some difference, but these things don't last forever, as we've learned in the last couple of weeks.
And for those of you inclined, my colleague Terry Baker, who does his own Europe, Middle East, and Africa focused podcast, recently had an editor from China Daily on to talk about the kind of changing behavioral patterns of outbound Chinese travelers. So definitely an interesting listen. A lot of talk about that kind of cliched group, like travel package group. Like it's a much more independent, like Western style trip to Europe now. Not that necessarily is the same thing across Asia Pacific, but who knows? So,
but it is. It's changing here as well for exactly the same way. Right. If you look at a market like Maldives that used to have 30% Chinese, and then it went down, and now you have totally different travel as that market has rebounded. It's, we used to talk about $0 tourism, right? And that's not really a topic anymore. You could see it in Bali and other places as well.
So, Steve, you mentioned.
Markets,
sorry.
As those markets, sort of Asia Pacific markets, are highly fragmented. They mature obviously at different paces, and I guess if you start to look at the Chinese traveler going into sort of upper upscale and luxury now, it is dominated by transient, right? And then there is still some groups blowing in there, but that mid-market sort of group business is not in all markets. And I guess my commentary as well, and without factual basis, would be that when the transient come out of China, it must be harder to stop that traveler traveling or influence that traveler rather than influencing a massive group, right?
That's a really good point. That's got to happen. I agree, because when you can tell a third or fourth tier group coming through an agency, that's a totally different game than saying middle income, a couple, no kids, traveling out. They will make their own decisions. Now, they will probably listen a little bit to trends, but I think that's a really good point. We'll see maybe less impact on how that's controlled.
So, Steve, you mentioned this has been a good year for money flowing across the region. I guess I just want to ask a little more specifically, kind of where's that money coming from, like, and who's spending it?
Yeah, sure. Well, I guess the first statement I'll say is, look, I've been doing this for a long time, and we now have a very broad, diverse set of investors. We've probably got a more broader set of investors today in hotels than we ever have before.
Yeah.
And historically, we were driven in Asia Pacific by high net worths and private money, and that's sort of a general statement. It sort of was more long rather than short. I guess the introduction of private equity, let's say 15, 20 years ago within the industry, has sort of looked to tap into some of the inefficiencies that we talked about before of at the asset level to get scale and to drive sort of growth and strategy through these assets. So where we are today is a broad set of investors that are looking to invest in living as a whole and operational real estate as a whole. And hotels, given its natural daily and short-term perspective, i.e. check in, check out on a daily basis, has that growth potential. And I think the important thing is that operational real estate can mark to market much faster than some of the other asset classes and beat inflation, right? And that's the core name of the game of how much can you beat inflation by, and what risk am I taking on to achieve that sort of growth. So the investors today, and I categorize them sort of either, depending on the country, domestic capital or international capital, and cross-border sort of capital is that international sort of piece. And if you pick up a market like Japan, 12, 18 months ago, dominated by the private equity folks into that sort of sector. And when I say dominated, like half the trades would have been in offshore capital. What we're seeing now is the domestic capital, given its much lower cost base, the REITs, Japanese REITs in particular, are leading the charge. They will dominate this year and into the future. What's happening and dominating sort of tier one markets, Tokyo, Osaka, Kyoto, some of the main resort destinations in Japan as well. And the value add opportunistic investors are really having either to do two things: take on more risk and price it accordingly, or find more value at the asset level and price it in, or move to secondary, tertiary, and other markets that they believe is still got value to unlock at the asset level, and the market dynamics are sort of similar. So Japanese, you're talking about the REITs, the Japanese conglomerates such as the railway companies and other Japanese corporations that continue to invest. Some of them are also being a lot more efficient with their capital. So they're not just buying, they're recycling. They're recycling out of real estate and into real estate, or out of real estate and into their core business. So it is a much more efficient capital strategy by the Japanese today, and they are incentivized by the government to sort of do that. The last one would be the family office market. Then that's evolved, and it's not just high net worth investing on their own in a singular sort of look. It's either single family offices or multi-family offices, i.e. a platform looking after many high net worths. That's rising to the surface. But the overarching points being, one, generally in hotels, it's more value add and above type return. So that drives the type of investor. And then secondly, in markets like Japan, dominated by domestics, but there still is a very big wave of institutional capital that needs to place across hotels. And in markets like Seoul and Hong Kong and Australia, we're still seeing strong depth.
You know, there's a couple things you said in there that I think are going to make all of the U.S.-based hoteliers who might listen to this very jealous. A, talking about hotels beating inflation, because that is feel like it's not happened much lately over here. And B, REITs actually having the ability to really make any moves and not just kind of fight for their existence, because I feel like the hotel REITs on the state side have been struggling for a bit now.
Well, I caution that in Japan, that's right, where cost of debt is almost free. In other markets, whether it's other REIT markets like Hong Kong, Singapore, Australia, less so for the obvious reason, as you call out.
Yeah. So before we move on to Jesper's favorite topic, which is always our sports talk. I guess I wonder, Jesper, if you have any burning questions for Steve, since we have some real expert opinion this month.
Well, I suppose in one way it's related to this. Since before I left Japan, I was in the not too enviable position of trying to find a new office space in Tokyo. And it is interesting,
Did they
right?
put you in
Because-
charge of that, Jesper? You're in facilities for
Yeah,
us?
yeah, that's right. We wear many hats, but it's interesting because I was reading up after the whole impasse that happened, and obviously setting political statements aside. So I was reading on that the concern about the yields on Japanese bonds is a risk there, and then because that and the yen, there was a lot of conversations last week that happened. Will the Bank of Japan continue on that low inflation? I suppose the first one is there a risk, even however strong Japan is, it's safe, it's large, very liquid, is there a risk of capital flight and like medium term from Japan? I think commercial real estate looks great because the vacancy rate is below 1%, according to CBRE data, right? It is incredibly hard to find anything. But do you see that as a risk then for that capital flight, for that movement to turn on the fiscal policies the Bank of Japan seems so stubborn in doing?
Yeah, I think there's the two key points to that is you've still got to consider there's a lot of domestic Japanese capital that will continue to invest in Japan, whether and aren't impacted by currency, right? Are not impacted by currency. So, and a lot of them do not invest offshore, right? So, and let's say that's half the market, right? So, put it to one side. Will interest rates potentially rise and currency appreciate, yen appreciate? Will that impact offshore investors' buying power? It has to, right? It has to. So will they stop altogether? Absolutely not, because of the depth and the breadth of that market. It's such a big market. There's, as I said, you could either take more risk at the asset level to achieve returns. It's such a big market, and you have much secondary and tertiary markets, which they can also enter and get similar sort of dynamics. However, we are starting to see what happens is when debt comes down in other markets and opportunities arise in other markets, and I'll pick up a couple of examples. There's a lot of international capital now looking at Seoul. It's got a similar dynamic to Japan. It's got a low supply, limited, very like nil, and ADR growth's very similar to Japan. So you got an underpenetrated brand environment. It's probably 18, 24 months off where Japan was or Japan is. So people are really reviewing that market, and there's opportunities there that I believe are a very similar profile to Japan. You've got markets like Hong Kong, right, where you're sitting there and saying it used to be the center of Asia. I'm a believer in Hong Kong. It's starting to reshape itself. There is a continued recovery in the hotel market there. There's a growing student population that's making student housing and PBSA and co-living living classes really attractive right now. We've seen 3 or 4 trades this year, and there's some bigger stuff that's coming to market and in market that will really test that Hong Kong market. So people believe Hong Kong has bottomed, and so the buyers that are a believer in Hong Kong are starting to move. And then other markets, like you pick up resort markets where you look at whether it's Maldives, Bali, Phuket, Da Nang, and the inbound and diverse inbound and the flight capacities into those resort destinations today. There's an argument that they're mispriced, right? There's an argument that seasonality doesn't really exist. It's sort of like Hawaii in some regards. Yes, the weather patterns change, but when you've got diverse southern hemisphere, northern hemisphere flight capacities, people are looking for sort of that 12-month annualized sort of stay. I do believe some of the yields on offer in those markets is quite attractive with growth, right? So, look, getting back to your question, I think my 2 points, as I said at the start, would be one, Japan's still going to continue to grow over the next couple of years and be highly attractive, and the domestic market will lead the charge. Some of the inbound capital will find it harder to place money, and they'll move to other opportunities that are arising, and that could be Seoul, Hong Kong, resorts as a general, but they'll find a home for their money. So I guess there's more competition across Asia Pacific today in placing capital than there was sort of 24 months ago. So more opportunities, sir.
But all money that must be placed will eventually be placed, right? That's kind of the
As a broker, you hope so.
So the one last thing about Hong Kong, I do want to ask, do you feel like part of the optimism there is the sense that it's been long enough that it's kind of shaken the stigma? Because obviously, like, part of the downturn there was just concerns about, the trajectory of the market, whether it was really this kind of like open global business destination that it always had billed itself as. Do you think, people kind of have a short memory for these things. Have we kind of just moved past that worry?
I think the people really close to Hong Kong, i.e., Asian capital in particular, have somewhat moved past that. I think Hong Kong is starting and on the journey to reshape itself, and whether that's through sort of the new KTAC Stadium, whether that's through people getting comfortable with the Shenzhen train. Now you can get into China in sort of 12 minutes, which is just another experience for Hong Kongers and tourists going to Hong Kong. The corporate fabric and the tenants that are moving into the office are starting to sort of, it's still very much the insurance companies, the banks, and part of their a global company being in Hong Kong and the center of Asia. So that's starting to sort of move back. And look, there's been a couple of really large office trades in the market, right? So if you talk about real estate, there are not just hotels, there's been some very large office trades, and that's by Chinese companies looking to take out floors in prime office buildings, right? And so I think we're still on a journey. We're not there yet, but our general view is Hong Kong has bottomed. It's coming back up the other side, but it's much more diverse today than it was sort of 10 years ago, right?
Yeah, I think Steve's not alone in this sentiment for sure, right? It seems to be everywhere I go, people are talking up this, and sometimes you go, oh, is that just self-interest where people bring them up? But no, I think it's the supply balance as well, and everything that is moving. And there's always this myth as well that everyone left Hong Kong. Everyone did not leave Hong Kong, right?
We have kind of the same story stateside with San Francisco, right? Like the similarities of them being great global cities that have kind of taken it on the chin. Like eventually it's going to come back to some degree. Like maybe it'll be different. Maybe it won't be exactly the same, but it's not like it's just going to disappear into nothing overnight, All right. So in our preparations for this call, we did check to see what sports talk Steve might be interested in, and I think I'm glad that we do this at the end of the podcast, because now everybody can know for sure that we didn't invite him on specifically because he's the Sydney guy. But it is the AFL offseason, so there's only so much we can chat about. Steve, you said you wanted to talk about cricket, which is not a conversation I can really contribute much to. Other than is to say, I was scrolling through Reddit the other day, and the AFL subreddit popped up, and there was a little video of them replacing the pitch at the MCG, and it was like a little bit of a heart pang, like, oh, it's a shift of the seasons.
Exactly. But I will have to say, I know we don't want to talk about cricket, but Australia has just beaten England in the first Ashes test, which is a big deal for England and Australia. And
no, I've once again, second reference to Terry Baker on this. He brought it up when England was surprisingly doing well in that.
Oh, he brought it up, did he?
He brought it up to us.
Oh, that was unfortunate. Because Steve has been very generous. It's like, yeah, they beat them. Like they did more than beat them. It was the fastest since 1920 or something, right, Steve? I mean,
please do take your victory lap on this.
I've never seen any cricket like this. It was insane.
Having been a long, happy and sometimes suffering Australian cricket fan, we'll take the win, but the next game will be a critical point, because it's been a while since we've been able to put sort of number of wins together like that. So I'll take it, but look forward to the next one.
Yeah, go to Brisbane, but this kind of opens the question, like, will MCG even host anything? Now, obviously, things are booked and the Valmy Army will stay in the country and spend money, a lot of them over Christmas, but I wonder if, financial impact. What if, Sydney's always at risk in one way as the fifth test series, but for all the markets has moved down, if this is a clean sweep, it takes the edge off. I mean, I wonder do you think that'll impact these markets at the tail end of the series, or is it no? There's enough people staying there and traveling around and spending money.
Yeah, what you find, and look, I was in Australia maybe 3 weeks ago, and what you do find is the British come because it's obviously the summer down there, so it's a long way to go. So they're not coming just for the cricket; they're coming for the cricket and then touring around. So having sort of it probably wouldn't be ideal having a 5-day cricket match finish in 2. I guess it gives them more time to sort of do other
Maybe it is
activities,
ideal.
whatever it
Yeah,
may be. So,
yeah.
but I
For
don't think
Perth, it
so.
was pretty bad. For Perth, it was
Yeah,
bad, right?
they probably got out of Perth and went to Margaret River or flew to the East Coast. So
Yeah,
you don't want it. You don't want it a 2-day from a tourism sense. But the British are there in loads. And as we start to get into sort of December, Australia does sort of turn its head to cricket. Most people, and so
Mm.
you'll get huge crowds in Sydney, Melbourne, Brisbane, Adelaide. So expect that to continue. But I would look. My view would be it is going to be much closer in the next couple of tests. Right,
Yeah.
England will probably win a couple of tests, and it will sort of balance out. So, which you won't get the English taking off home early. I wouldn't have thought.
No, it's going to
Well,
be a great Christmas, good Boxing Day action.
Yeah, for sure.
all right. Well, on that victorious note for Australia, thank you, Jesper and Steve. This has been a wonderful conversation.
Thank you, Sean.
Thanks, Sean.
I'm Terence Baker, News Editor, Europe, Middle East and Africa, and I'm the host of The Upgrade, a CoStar News Hotels podcast for the EMEA region. In it, I discuss with special guests the pressures, challenges, joys and exhilaration that comes with managing, owning and developing hotels in our glorious multifaceted industry. Discovering the EMEA region from the scenic northern shores of Norway to the heights of Table Mountain in South Africa, and most likely some chat about birdwatching, distance running and the English Premiership. Join us wherever you find your podcasts, on Apple Podcasts, on Spotify and on other platforms.
This episode of the CoStar News Hotels podcast was recorded on November 24th, 2025 and edited by me, Sean McCracken. Head to costar.com/hotel news for more and make sure to rate, review, and subscribe all of our podcasts on your platform of choice.